Hello friends, welcome back. So were you able to solve the self-assessment question of the cash flow statement from the previous video? Here is the solution to that particular question on the cash flow statement. This was a question that was posed to you. From the following balance sheet of DCX Limited and the additional information as on 31st March 2018, prepare a cash flow statement. This was also a previous year examination question. This was similar to the one that I solved in the previous video. Look at the items. The first step, as I told you in solving the cash flow statement, is read the question thoroughly to identify what are the items that you are required to deal with while preparing the cash flow statement and understand it. So that's the first step that we're going to do. First one is shareholders fund divided into share capital and reserves and surplus. Share capital, if you see, was 21 lakh, which has changed to 30 lakh. So there is an increase in the share capital. The share capital increases when the company has issued shares and collected money. And therefore, in this case, it is proceeds from issue of shares. Again, you have to be careful to look at the additional information if any information about the increase has been given, because there is a possibility that share capital increases, but it might be two different categories of shares, one equity share, one preference share. One might have been issued, one might have been redeemed, the net amount might come here. But here, as there is no reference to any other working note, it just means there has been issue of shares worth 9 lakh. Therefore, this would be an inflow in the financing activity. Second, reserves and surplus. There is in the notes to accounts, you have to refer to it and see what this amount relates to. So we will deal with it when it comes to the notes. The next one we have is a long-term borrowing. Here again there is an increase, so we have increased the borrowing during the year, and we will have to go and see what is the type of borrowing. So when it comes notes account, we will discuss that. Further next, and this long-term borrowing is a part of financing activity. So this is a part of financing activity. This is a part of financing activity. This we will refer and see in the working note and decide what is the particular amount. Because reserves and surplus can be the balance in the as a surplus balance in statement of profit and loss account. It can be other items as well, like general reserve or securities premium reserve and so on. The next is the current liability, where we have trade payable. This would be a part of our working capital changes. So it would be in the operating activity that we would adjust it. What has happened here? The current liability has increased. Fall in the current asset or increase in current liability is an add item. Here it has increased, so it is an item of add. If the current asset increases and the current liability decreases, it is a subtract. So here there is an increase in the trade payable or current liability, so this would be an item of add as a part of working capital changes under operating activity. Then moving further, short-term provision, we will refer to the notes to accounts and decide how to deal with it. Basically, it depends upon the item specified there. If no detail was given like in the last, we just used it under the same working capital changes. But here, because there's a reference to working note, we have to see what is the specific item which is covered under this subhead. Now, going to the asset side, we have non-current asset, fixed asset, we have tangible asset, again reference to notes to account, to go there. And intangible assets, there is an increase in intangible asset, means during the year asset has been purchased. So it is going to be a part of your investing activity. There is a purchase. So there is going to be an outflow. And finally, we have the current asset, where we have current investment, inventories, and cash and cash equivalent. As you know, the current investment is a part of cash and cash equivalent. So when we are going to be writing in the cash flow statement, we'll add the current investment, cash and cash equivalent, and those two amounts together would form the balance of cash and cash equivalent at the beginning and cash equivalent at the end. So now we are left with only inventories. This would be a part of the operating activity, that is a working capital changes. So here what has happened? It has increased. Means last year we had 4 lakh inventory, now we have 8 lakh, means we have purchased more. So it is an outflow, or increase in current asset and decrease in current liability is a subtract. So from this, so far understanding, we have understood what are the items that are going to come in cash flow statement and where. Now moving further, now looking at the notes to accounts, we find that reserve and surplus includes only the surplus balance. So this would be a part of our operating activity. In finding out the net profit before tax and extraordinary item, we would be taking the difference in surplus. And if you see here, actually what has happened is 5 lakh was the balance in the statement profit and loss account, which has fallen down to 4 lakh. So closing minus opening, 4 lakh minus 5 lakh, you would have a negative of 1 lakh would be the starting point. In determining net profit before tax and extraordinary item, we would start with the negative of 1 lakh. We'll be preparing a working note for that. Then long-term borrowing is represented by 8% debentures, and this increase, it means it is a part of financing activity and there has been issue of debentures during the year. So it represents our amount of inflow of proceeds of 3 lakh. Now important point here is we have to see whether the date when these were issued is given. Why? Because they are entitled to get 8% interest. So whether these people who are lend the money to the company, whether they are eligible to get interest or not, depends upon when the money was borrowed by the company. If it was at the end of the year, then they were not eligible and you would take 8% on 5 lakh. But looking at the additional information here, you see debentures were issued on 1st April 2017, which means at the beginning of the year only this 3 lakh debentures were issued. So totally, you will be calculating the interest on debentures at the rate of 8% on 8 lakh. Now, this being a part of the financing activity, the interest which is to be paid would be an outflow under financing activity. And secondly, in the operating activity, you need to remember that there is something called as non-operating expenses and losses. So under the non-operating expenses, this particular interest on debentures would be added because it's a non-operating expense which was subtracted in arriving at the net profit. So we add that back. Then next, coming to this short-term provision, this provision for tax, only the opening and closing, there's no other information. So as I told you, this is the provision of last year. This would have been paid during the year. Therefore, this would be a part of the operating activity. We would be subtracting less income tax paid before arriving at the cash flow from operating. And this 76,000 is the current year provision. This would be a part of calculation of this net profit before tax and extraordinary item. We would be taking this particular amount as an add back. So to this 1 lakh, we would be adding back the 76,000 and would be arriving at the net profit before tax and extraordinary item, which we would take into the balance sheet, cash flow statement. Finally, the tangible asset represented by machinery. We have the opening and closing and we have the accumulated depreciation. So we will be preparing the two accounts, machinery and accumulated depreciation account. The opening and closing balances will be written there. Machinery has an opening debit and closing credit. Accumulated, the opposite, opening would be credit, closing would be debit. And there is additional information given related to that which we would incorporate into the machinery account. During the year, a machinery costing 8 lakh, on which accumulated depreciation was 3 lakh 20, was sold for 6 lakh 14. So in this particular depreciation that we have 5 lakh, this 3 lakh 20 is related to the machinery which has been sold. So we will take it out from the accumulated depreciation account, transfer to machinery account. We would have the sale value incorporated to machinery account. We will calculate whether there was a profit or loss. How to find out? I will show you. From the cost, we reduce the accumulated depreciation to arrive at the book value on the date of sale, which will be compared with the sale value, which will give us the profit or loss. And we would incorporate the profit or loss in the machinery account. Once we have done that, we would get the balancing figure in the accumulated depreciation. It would be the depreciation for current year which would be an add back in the operating activity under the non-cash expenses. And the balancing figure in the machinery account would be the purchase of machinery made during the year, which would be an outflow under investing activity. In addition to that, you would have the inflow of 6,40,000 related to sale of machinery too under the investing activity. So having understood the question, now we will go about the next step, that is prepare the format. Now, having understood this, we will prepare the format in this manner in the books of the company, cash flow statement, and if you have the year, know the year, we write for the year ended, whatever is the year, that year we would put here. Particulars, amount, two columns. We start with, first one would be the cash flow from operating activities. So under this, we are going to start with the net profit before tax. For this, we would prepare a working note, give working note reference 1. Then we would be adjusting, and the adjustment is for non-cash and non-operating items, where we add back the non-cash expense and non-operating expenses and losses, and we would subtract any non-cash income or any non-operating income or gains. So as far as I remember, there was a depreciation which we would add back. There was a non-operating expense of interest on debentures. So we have at least two items. So of non-cash expense, one that was depreciation and one of non-operating expenses that is to be added. And there was also sale of machinery, so there was going to be a gain or loss on sale of that. We will not know till we do the calculation whether there was a gain or loss. So leaving around 3 lines, one line for the, in case there's a gain, then we have to subtract, one more line we'll leave, and what we get is called as operating profit before working capital changes. So once we know this, we know that next what we are going to do is the working capital changes. And looking at the balance sheet, if you remember, we had noted down there are only two items related to working capital. One is add, one is a subtract. So as simple as that, we know we have to add one item and we are going to subtract one more item. So what are we going to add? Whenever there is a decrease in current asset or an increase in current liability, it is added. And the opposite, if there is an increase in current asset or a decrease in current liability, then it would be subtract. So you remember just one of this, which is add, the opposite would be the subtract. Now once that is done, we go further and we would be writing whatever is the cash flow from operating activities, but this is before tax. So next we would subtract the income tax paid. So what we ultimately arrive at is the cash flow from operating activities. And with that, the operating activities part will be completed. We go to the second, that is the cash flow from investing activities. If you remember, investing activities are the activities related to our long-term assets and non-current investment. And we had here long-term tangible and intangible assets. So there was machinery where there would be a sale and a purchase, and there was also an intangible asset. Therefore, at least 3 items were there. We leave 4 lines, and then we would go for the next category, that is cash flow from financing activities. Now financing activity means it is related to the share capital, the long-term borrowings. So basically, here we remember share capital had undergone a change. There was long-term borrowing, there was debentures, and there was interest related to that. So leaving around 3-4 lines for that, we would be going further. We would be getting the D, that is the net increase, or there can be as well, if it is in bracket, a decrease in cash and cash equivalents. And to this E we add the cash and cash equivalents at the beginning. And we would arrive at the last one, that is the cash and cash equivalents at the end. So with that, it would be completed. This would be the format of a cash flow statement. Third step would be go back to the question and start with the liability side items, put it into the form. So share capital, no reference, directly increase. So there were issue. Under the financing activity, write that amount as proceeds from issue of shares. An increase of 9 lakh. So there is an inflow of 9 lakh. The next was reserves and surplus. Referring to working note, it was nothing but our surplus balance and statement of profit and loss account. So now we will go and prepare a working note for this to arrive at the. So here working note number 1, to find out the net profit before tax and extraordinary items. So to find out this amount, we are starting with the closing balance of surplus. We would be subtracting the opening balance of the surplus. Now, if you remember, what was the closing balance? It was 4, opening was 5. So, 4 lakh minus 5 lakh. So, you get a negative of 1 lakh. Now, this 1 lakh, we go further. That is done. We go to the next item, which is non-current liability. We have taken this. So here non-current liability, again reference to this 8% debentures, which is increased, and it said that increase means issue of debentures during the year, which was issued at the beginning of the year. So it's a part of financing activity. So proceeds from issue of 8% debentures. So it has increased by 3 lakh. Now immediately we'll take into consideration the interest part also. Because it was issued on 1st April, those debentures were there entire year, so they are eligible to get interest. So we will calculate the interest on debentures, which would be an outflow at the rate of 8% on the entire amount of 8 lakh. That comes to 64,000. So you will show a outflow of 64,000 here. The other effect that you need to remember is that it's a non-operating expense. So interest on 8% debentures would be added back 64,000 because that has been subtracted and arriving at this number. So two effects when it is additional information as it were. Now once this debentures we have taken care of in financing activity and the interest part. Going back, here we have next item of trade payable, working capital changes. There is an increase in trade payable of 50,000. So going here increase in current liability is an add. So we'll put trade payables here, increase of 50,000. Then going back here, next item we have a short-term provision. Looking at the notes to accounts, it is represented by provision for tax. As I told you, last year's provision would have been paid. So 56,000 is the income tax paid, which would come here. As the last part of our operating activity, less income tax paid would be 56,000. And whatever is the provision of the current year 76,000, that has to be added back in the working note here, because this is related to provision for tax, which was subtracted when arriving at this net profit. So we have to take that into consideration and add back. This is current years, which is 76,000. So when you add back, you get a negative of 24,000. This is the amount which is net profit before tax. This you can immediately include here and say negative of 24,000 is your starting point of cash flow from operating activity. Hope that's clear. Now going back to the next one, we have finished the liability side completely. Going to the asset side, tangible asset, note, look at that. They have given the opening closing balance. Now we'll be preparing a format. We'll be preparing account, a machinery account, accumulated depreciation account, and we'll put in these amounts. Opening 25, closing 33. So we prepare a machinery account like this, debit and credit on either side. Opening balance would be on the debit side. To balance brought down, you have a balance of 25 lakh opening, and you have a closing balance on the credit side by balance carried down of 33 lakh. Now, for accumulated depreciation, if you look at the question again, opening was 5 lakh, closing was 6 lakh. So going into the account, opening would be a credit balance. On the credit side, you write by balance brought down 5 lakh. And the closing would be on the debit side to balance carry down 6 lakh. That's it. So with this, we have taken into consideration and taken these amounts as well. So this tangible assets has been also dealt with. We have the intangible assets. Increase. Intangible assets have increased means during the year purchase some intangible assets. The detail is not available, but it represents an outflow under investing activity. So going to the here the investing activity, you write purchase of intangible asset. So the intangible assets has increased by 1 lakh from 7 lakh to 8 lakh. So there would be outflow of 1 lakh. After this, we are going to look at the next one. So intangible asset dealt with. Now we have current investment, cash and cash equivalent to be taken as a part, it should be added together. So we will go and prepare a note for that here. So we'll find out the cash and cash equivalent figure. You can either prepare a note like this, the working note number 2. This is the beginning and end figure here. So for the current investments, we'll write the amounts, and then the cash and cash equivalent, whatever has been given in the beginning and the end, and the total of this would be taken in our cash flow statement. So looking at the table, we find that there was 78,000 of current investment, the beginning which changed to 89, and cash equivalent was 78, the beginning which has changed to 37. So if you add this together, you would get 1,56,000 in the beginning and 1,26,000 at the end. So this where will we take? We will take it here. Cash and cash equivalent, the beginning was 1,56,000 and the end was 1,26,000, which means there was a decrease of 30,000 in cash and cash equivalent. Only then you would get this figure, the difference between these two. So once that is done, there is only one more amount that is left which you're dealing with is the inventories. We know inventories is a part of working capital changes under operating activity, and it is increased, means during the year of purchase. So there's an outflow. So increase in current assets, subtract of 4 lakh. So going to the operating activity, here you write inventories of 4 lakh is a decrease. So now if you see, we have dealt with the entire item here, individually we have put it somewhere or the other, and we have also dealt with all these items. Now what we're left with is only this particular thing which we have to incorporate from the additional information into our machinery account and accumulated depreciation. So there was a machinery costing 8 lakh, which was having accumulated depreciation of 3 lakh 20. So 3 lakh 20 and was sold for 6 lakh 40. So that means in our machinery account, we are going to be having to transfer from the accumulated depreciation account, we are going to be transferring the depreciation related to the machinery which has been sold, which was 3,20,000. So we remove it from here, from this, and we are putting it into the machinery account. Then there was the sale value which was given, that is realized, that was 6,40,000. So we write that too. Now what we are supposed to do is find out whether there was a gain or loss. Working note number 3, to find out whether there was gain or loss. So the cost of the machinery was given to be 8 lakh rupees. And the accumulated depreciation related to that, they said, was 3,20,000. So the book value on the date of sale is going to be 4,80,000. We'll compare this with the sale value. They said it was sold for 6,40,000. So obviously we have sold it for more. The difference is how much? 20, 40, 60, 1,60,000. So there was a gain on sale of machine which has to be incorporated. So going back to this account, we can write the gain is always credited to the statement of profit and loss account. This was the gain on sale. Loss is debited, gain is credited. So 1,60,000. So once this is done, we can start closing the accounts. First, we'll close out the accumulated depreciation account. 9,20,000 minus 5 lakh gives us 4,20,000. This is represented by the depreciation for the current year, the balancing figure. This we would take it in the operating. Then we'll close this account. The total of the credit side is more. Take it 60,000. 42,60,000. So we have 41 minus 25. So it is going to be 16 lakhs. So this is represented by the purchase of machinery made during the year. This is the balancing figure of the machinery account. Okay. From this, you have to remember the gain on sale of machinery would be a subtract item in the operating activity because it's a non-operating gain. The purchase would be in investing activity and outflow. The sale would be inflow under investing activity, and the depreciation would be in the operating activity, a non-cash expense. So let us incorporate this. Here see, we would have the depreciation non-cash expense of 4,20,000, and then we have a gain on sale, so less gain on sale of machinery, that was 1,60,000. So we write that 1,60,000 here. Then we had a purchase of machinery which came up to, I think it was 16 lakh, and sale was 6,40,000. So Purchase of 16 lakh is an outflow under investing activity, and sale of machinery is an inflow of 6 lakh 40,000. So with that, we have incorporated everything. All we have to do is start with this also we have taken here. So we start calculating. So these are the two items that have to be added. So it is 4,84,000. So when that is subtracted, you get 4,60,000, and this 1,60,000 has to be subtracted. So we get operating profit before working capital changes as 3 lakh. To that we add 50,000. So we get 3,50,000, and we are going to subtract 4 lakh. So you are going to be left with 50,000 in the negative. Now we are going to further subtract 56. So this is also in bracket. So you are left with 1,06,000 in negative. So this is the cash used, you can say, in in operating activity. Now going to the investing activity, 16 plus 117 lakh minus 6 lakh 40 would give you an outflow of 10 lakh 60,000. So this is represented by cash used in investing activity. So here also it is used. Finally, financing activity 12 lakh. 12 lakh minus 64 would be 11 lakh 36,000. So this is cash flow from financing activity. So just add these three together. 1 lakh 6 plus 11 lakh 60. That would be 1 lakh 6. 11 lakh 66 minus 11 lakh 36. That would give you a negative of 30,000, and that is the net decrease in cash and cash equivalent. So see how we were able to solve such a cash flow statement question with ease. So please follow the step, do it systematically like this. You will be able to solve it very easily. So friends, that's all for now. Please do like and comment about the video. And if you have not yet subscribed, please do subscribe to the channel. Thank you. Have a great day and stay tuned.